We're still very, very early. Many of these investors are still barely dipping their toe in. But it is changing. They're realizing that they have to. They at least have to get educated. They have to at least have an answer, whether or not they agree or not. It's not going to be good enough to say, we can't address this. It's too small or whatever else their excuse was before, because now, of course, it's $4 trillion or more for the total space.
A whale sold 24,000 Bitcoin in one clip this past weekend, and everyone is wondering if the top is in or if the market is so big and liquid now that we can just shrug off these things and keep chugging. Plus, we're going to get some insight into institutional adoption of digital assets today. Hello and welcome to Milk Road Macro, the podcast that believes we should send central bankers to Jackson Hole more often. I'm your host, John Gillen. Today is Monday, August 25th. And we are joined today by Chris Kuiper. Chris is the Vice President of Research at Fidelity Digital Assets, where he leads the firm's research on digital assets, as well as provides insights on this whole asset class to institutional investors. Previously, Chris built a very successful career in equities research and holds a master's degree in economics from George Mason University. If that sounds good to you, make sure you like and subscribe. Share this episode with someone who's going to enjoy it. I'm really excited for this one. One other big announcement I want to make everyone aware of. Huge week here at Milk Road. We just launched Macro Pro, our brand new website. It looks great. I want to lick my screen when I look at it. I'm probably not supposed to say that, but we'll edit that out if we have to. Macro Pro gives you the hedge fund level analysis that big players pay top dollar for. You're going to get live AMAs, monthly macro reports that are really great deep dives into everything going on in macro, as well as direct access to me and our whole research analyst team via private Discord. And here's the kicker. Until Wednesday of this week at midnight, you join, you get 25% off. Or if you want to go for the full Milk Road experience, that's macro, crypto, and Degen, all under one roof. For the very first time, you can grab Pro All Access, also at 25% off. Link is in the description. Today's episode is brought to you by KGeN, the verified distribution protocol changing the growth game. And without further ado, I'm very pleased and excited to welcome to Milk Road Macro, Chris Kuiper of Fidelity Digital Assets. Chris, how are you today?
Very good. Very good. Thanks for having me.
Great. Well, I'm very happy to have you here. I want to start with something that I think a lot of people are wondering right now. Bitcoin has been range bound for a few months. It's holding its ground above 100K. But Powell's dovish comments at Jackson Hole, I think, really kicked off a lot of action, growth in risk assets in general. But Bitcoin hasn't really started to follow that trend upwards yet. What are you seeing around this? Do you think Bitcoin is going to join the rally? Do you think it's going to face some continued headwinds? What is your read on the Bitcoin market right now, where we are today?
Yeah, so Friday's move was pretty explosive for a lot of the digital assets here. And as you pointed out, Bitcoin did move up a bit, around $4,000 a coin when the comment came out from Powell. That was very dovish, of course. And but this was nothing compared to like Ethereum, which was up over 15%, I think, at one point when I looked on my screen around the comment time. So that is a good question. It's why isn't Bitcoin rallying more? Number one is to remember, zoom out, Bitcoin was already rallying and outperforming Ether by quite a bit. The other thing to note, and this has been a theory of mine for a while, and so have to be careful because this is just one data point, but I've always said Bitcoin is not a risk on asset. And what I mean by that is when we say risk on, we usually mean like when things are getting dovish, easier money, more liquidity, people can tend to get more speculative. They want to take on more risk. And that's when they've typically turned to Bitcoin and other digital assets. They put them in a risk on bucket. But if you think about Bitcoin from a fundamental level, to me, it's the opposite of risk on. It's less speculative because you know everything you need to know about it. Every 10 minutes, there's going to be another block on average. You know exactly how many new Bitcoin are going to be released. You know how many Bitcoin will be in the future. There's a set monetary schedule. You know the cap of 21 million. All of those things are known versus other things like even traditional financial instruments like stocks. You don't know what their cash flows are going to be like. You don't know what their dividends are going to be like. So there's a lot of unknowns there with those assets. And Bitcoin, to me, is the exact opposite. So maybe, just maybe, this was just one data point where we've seen people recognizing that Bitcoin isn't the risk on trade anymore, but maybe it's these other things. Maybe it is the other digital assets that are the risk on trade. So we'll see. We'll see how that plays out. But again, two things, zooming out, Bitcoin already had a rally. I think you're seeing a classic rotation into the riskier altcoin space. And then on top of that, maybe now at over 100,000, staying there, solidly $2 trillion asset class, people are looking and understanding Bitcoin more as not just a risk on asset.
That's really helpful, and I think a really useful perspective. I worked at BlackRock for 6 years, and our head of digital assets there also made the same point. I think he wrote an entire white paper on it about how
Hmm.
the institutional investor landscape is changing their view of Bitcoin from a risk asset to a risk-off asset. So I think that's a really helpful perspective. I want to get some more context on that, but first I want to just like kind of have frame for us where you see Fidelity as a participant in this market in the digital asset space, because we've seen, there's a lot of crypto native companies, there's a lot of Wall Street players getting involved now, and sort of like a hybridization that's happening. Differentiate for us Fidelity Digital Assets. Where do you guys see yourselves fitting into this marketplace, and what niche are you trying to fill?
It's a story I love to tell. Obviously, it predates me, but I love to tell the story of how Fidelity Digital Assets started. And it really goes back to the late 90s, before Bitcoin was even invented, when Fidelity created a pure R&D center, research and development center, to just look out at things in the universe, in the industry, that could enhance their business, maybe disrupt their business. And this research center, of course, found Bitcoin as early as 2012 or even before that. And what's interesting about this group at Fidelity is they don't just read about it. They don't just read white papers or academic things. They get their hands dirty. They play with it. They seek to really understand it. So they started playing with Bitcoin. There's a famous story of Fidelity trying to use Bitcoin in one of the cafeterias way back when. This was before Lightning Network was invented. So you can imagine it did not go well, waiting 10 minutes for at least one confirmation. But that's the stuff they do. And then, of course, they started mining Bitcoin. They started mining it on their desktops. There's even a story where they then ordered these miners from China. As you know, most of the ASICs come from there still today, and that was the only place you could get it. And that didn't go well from a requisition standpoint. The finance committee and others said, there's no way we're buying these, whatever they are, Bitcoin miners from China. And to her credit, our CEO, Abby Johnson, said, no, we're going to do this. And so they started mining Bitcoin, and then they realized they wanted a place to store it. And there was no enterprise grade, institutional grade custody solution out there yet. So they built their own. And this is also the goal of this research group. They want to look out what's out there, try new things, and then see if they can scale something new into an actual product. And so 2018, early 2019 is when Fidelity Digital Assets officially launched, and custody is still our main product today. And so that is where we differentiate ourselves from a lot of other people out there. We built our own custody from scratch. We still own and control that today. We custody our own coins for all the products you see out there from Fidelity, from the exchange traded products to our retail offerings to everything else. That's all custodied with Fidelity Digital Assets. So, maybe we're not as far along as some of the digital native counterparts, but if you look at the traditional finance landscape, we're leaps and bounds ahead of where all these other people are today. And so that's where we really fit in. We really believe in the space. I remember I started about 4 years ago. Bitcoin hit a new all-time high. A few months later, it crashed 70, 80%. And I wondered, oh boy, what's going to happen? And I was delighted to see Fidelity step on the gas and use that bear market to actually hire more people and build more. So we're very committed to the space. We have been for over 10 years. And that's where we are today.
Gotcha. Yeah, I appreciate that context, because I think everybody has had a different journey of adoption and education and sort of this learning curve. And I think Fidelity has been a unique participant and had a unique story there. So I wanted to kind of share some of that context with people so that they know where you're coming from. You're also now one of the leaders on institutional research in the whole digital asset landscape. I read your Q2 2025 signals report with great interest, a lot of insights in there. You talk a lot about rising global liquidity, declining volatility in Bitcoin. Just situate for us, for our audience, sort of your larger macro framework in which the context that we're in and how you're evaluating this, and then situate Bitcoin in that framework for us. Where does Bitcoin fit into the current macro landscape from your perspective?
Yeah, I wrote a piece on Bitcoin as a potential macro asset. And what I mean by that is, when we say macro asset, this is one of these finance terms that's everyone kind of knows what it is, but there's really no good definition. So to me, it's any asset that is traded globally, recognized by almost all financial institutions and participants, and it's traded on macro factors, things like liquidity and interest rates and inflation. And so we did, some pretty simple statistical analysis to say, what macro factors does Bitcoin particularly correlate to, not necessarily causation, but at least respond to and correlate to. And the two biggest ones are global liquidity or even US liquidity. So just take M2 money supply as a good proxy for that. Statistically significant, very high R squared. So depending on the time frame you're looking at, R squared of anywhere between 0.8 to 0.9 or above. What that means in practice is 80 to 90% of the change in Bitcoin's price can be explained by the change in the money supply. Now, you have to be a little careful. Like, this is looking at a long time horizon, not day to day, week to week, month to month, quarter to quarter even. And also what some of these people are doing on social media and stuff, where they're matching up, M2 with different lagged effects with Bitcoin. That may or may not play out. That's not what I'm saying here. I'm just saying as a general broad time frame, if you increase the money supply, you probably will see an increase in Bitcoin. At least that's what we've seen in terms of the stats right now. I happen to think there is good causation for that, not just correlation. So global liquidity is number one in our framework. The second one is inflation expectations. So not inflation like CPI, PPI, which are backward looking, but in inflation expectations. So if people think inflation is going to go up, that's when you see Bitcoin move. And the reason you have such a high correlation in R squared to this is really in that past moment when we saw inflation expectations absolutely explode with COVID, that's when Bitcoin ran as well. And then of course they came down, but the backward-looking CPI was still very high at 8-9%, highest it had been in 40 years. And Bitcoin was already going down. And of course, that's why you get some confusion where people say, wait a minute, I thought Bitcoin was supposed to be a hedge against inflation. We've got inflation at 40-year highs, Bitcoin's down, what gives? And that's the way to square that circle. It's like you have to look back at the expectations. Bitcoin is a forward-looking market, just like anything else. And that's where it really shines. So those two things are my big macro frameworks when I look at Bitcoin specifically.
Gotcha. That's a helpful perspective. And I think that a lot of people in the digital asset space have kind of like latched onto those things. I want to kind of like translate this into what we've been seeing in terms of like the recent pivot in dovish tone from the Fed. A lot of analysts are saying that it doesn't really matter if the Fed cuts rates or not, because eventually they're going to have to print, right? Like, Larry Lepard with his big print thesis, like the government's just going to have to keep adding liquidity. China, for example, has already added, I think, $1.5 trillion of liquidity so far this year, and are on pace to do at least that much or around that much the rest of this year too. So if global liquidity is just going to keep rising, and that explains much of the movement in Bitcoin's price, how much should investors pay attention to things like, Jackson Hole speeches and Fed rate cuts, or does this like ultimately not matter and the direction is going to keep going in the direction it's going?
Yeah, it depends on your time horizon as an investor. And this is where something like you mentioned our signals report, something we do. Any metric you look at, you have to ask, well, what time horizon am I looking at? Because it might say one thing for one time horizon, something else for another one, or you have to use the right metric for the right time horizon. So I'm completely with you, or whoever these other analysts are saying, and I know a bunch of them as well, where yes, on a zoomed out long time horizon, if you look at the chart of M2, it's just up and to the right. There was only a minor period recently where we actually had global liquidity, global money supply go down and actually have a negative year-over-year rate. Otherwise, global liquidity has always been going up, especially at least after we officially severed from the gold standard in 1971. And that's what underpins a lot of our economy and our system, right? That you have to have these ever increasing, inflating asset values to support the debt. At least that's my opinion. So yes, if you are a long-term investor and it's like, I'm going to hold this for at least 5 years or more, and the investment thesis of Bitcoin is something like a hedge or to protect yourself from currency debasement, inflation, I would agree. A lot of it is just noise. That's all just things you can tune out. Make sure that chart is still going up and to the right, and that's what you're going to see. If you're someone who's has to move or get in and out for whatever reason, or you need some liquidity or something, maybe that's when you start to pay attention more to these other narrower time frame stuff. So, rate cutting is one thing, but I think again, bringing it back to that framework, our research shows rate cuts and things like the 10-year Treasury, they're actually not statistically significant when compared to the price of Bitcoin. And I think that's because you have to think of the second order effect. So our rate if the Fed cuts rates, the question is, are they either going to add liquidity, add more, or increase the rate of the money supply? And the rate really matters, not just the amount. Or are they going to change people's inflation expectations? So again, rate cutting is one step. Think one step beyond that. Second order of operations here is what does that mean for these two things? And what's really interesting, I think, about Powell's pivot to get into this now is he leaned into the labor market as the reason why. And I suspected that because a lot of the inflation metrics are ticking up again. And so I think he could only lead into the labor market. And so at the very beginning of the year, we wrote a look ahead piece where I brought up the question of why isn't anyone talking about stagflation? And it wasn't my base case. It was just something I think people should at least raise the question with. And now, it looked like that was not going to happen at all. But now we've got a Fed cutting rates into a potential increase in inflation. It didn't even get that low. And you've got talk of them moving their goalposts yet again. So it used to be 0% inflation, 0 to 2, a range, then a 2% average. Now they might move that up again. So they're obviously getting more comfortable with having higher inflation. And then if they're worried about the labor market, to me, that sounds like they're worried about the economy. So again, that increases the odds of a stagflationary environment, at least in my opinion. And the reason I brought it up too is the only time we've had that in the 70s and 80s was when you had some of the same things. And also, we pointed out the reason why I said this could happen is if you look back then, inflation wasn't just one big, massive inflationary decade of double-digit inflation. It actually came in 3 separate waves. And so if you looked at what we had to go up to 9%, come down to 3% or a little bit below for CPI. What if we have another wave? What if the Fed thinks inflation's under control? They start cutting, it's not in control. We have another wave of inflation again, just like before, And again, past is not indicative of future, but we do look at some things that may rhyme.
Most Web3 projects launch a token first, and revenue, maybe later, maybe never. But KGeN flipped the script. $30.6 million in ARR before a token ever existed thanks to VeriFi. Cash flow positive, growing month after month, and powering 31 million verified users across AI, gaming, and consumer apps. In a market full of hype and empty metrics, KGeN is proving that Web3 can be built on real revenue, real users, and sustainable growth. Want your protocol to scale with results that last? Grow with KGeN today at milkroad.com/KGeN. Yeah. No, I think there's a lot of great analysis in there. And this is one of the reasons why I think it's so helpful to have you on, is that understanding the history of these things, of how the market and the economy has behaved in the past, can help us understand what might happen in the future. But I'm with you. I think there's a lot of things that are not my base case, but we're still watching out for, because we can't rule these things out. I want to come now towards something you mentioned in this framework of inflation expectations. A lot of that gets to what investors think, or what their sentiment is, or how they're treating or thinking about these assets. And I'm interested in hearing your perspective on how particularly institutional investors have changed their thinking on digital assets. I want to just start with one thing I saw recently. Eric Peters, who's the CIO of Coinbase Asset Management, said in a recent interview that we haven't even scratched the surface of institutional adoption yet for digital assets, but he thinks that that's coming. Do you agree with that assessment, that we haven't even scratched the surface? And what in your mind is going to bring that scratching through the surface, to get more institutional interest in digital assets?
I agree with that. From all of my anecdotal evidence of people I talk to, conferences I go to, institutional investors I have conversations with, we're still very, very early. Many of these investors are still barely dipping their toe in, but it is changing. They're realizing that they at least have to get educated. They have to at least have an answer, whether or not they agree or not. It's not going to be good enough to say, we can't address this, it's too small, or whatever else their excuse was before, because now, of course, it's $4 trillion or more for the total space. It's a political issue. It's been around it long enough that people are realizing it's here to stay. So I agree with that. To give you a few anecdotal stories, one is I was at a conference for pensions, and pensions are like the most conservative group. They're the ones with the lowest amount of adoption. And a few of them started getting a little more interested, asking at least more pointed questions to show that they were thinking about it. But there's still a big group, and one in particular, he ran a pension for a number of large cities, their fire and police, I believe, and he said he was in his 60s, and he said, I'm going to retire in a few years, and this is all interesting and great, but it's something for someone else to pick up the mantle on. And so I think one of the things that's going to happen is just time and a shift of generations from some of the current managers to younger people who are more comfortable with digital assets and everything being digital. And the other thing that will have to happen is the career risk will have to be gone. We talk about this a lot. If you're the only one out there doing this and it doesn't work out, or just the timing is bad, you can lose your job or your career. And why would you do that when you can just stay with the herd? And if you miss it, well, so what? So did everybody else. So the career risk has to go away. There has to be time and a generational shift. And then I think just if they can start seeing it's in their best interest and incentives as well, if they can outperform their benchmarks, outperform their peers on an institutional basis, that's going to get people excited about it too. At the end of the day, people are going to be motivated by their metrics and what they're judged on. And so that will have to be another part of it as well.
Yeah, definitely makes sense. I think price has always been the best advertisement for Bitcoin. So, but I appreciate that the changing of the guard and bringing in a newer generation that's more comfortable with the space and this asset class. That all makes sense too. Something that I thought that was really interesting. You put out some analysis recently, just commenting on the 5-year drawdown that we've seen in the U.S. bond market. And historically, this was a major place for institutional investors to put capital to make investments and trades. And, like you said, returns matter. 5 years in a row, we've had a drawdown in returns there. How has this started to change their perspective of hey, we need to look somewhere else for yield? And does this make them more open-minded to something like Bitcoin or digital assets?
It hasn't yet, at least from what I've seen, which I think is surprising, because I think there's still this idea of, well, bonds go through drawdowns just like everything else, so we'll just continue to ride this out. And they're right. Let's be fair. We haven't had a lot of data yet, but we had the recent show with Urian Timmer, who's a big macro guy here at Fidelity. He's all over the social media. It's really great stuff. And I had a conversation with him about this. And what was really interesting to me is he brought this up. Now, so his words, not mine, although I tend to agree, which is if we're in an environment, a regime where there is, let's just look at government bonds, treasuries. If there are fiscal deficits as far as the eye can see, the math is just really hard to square if you start doing the numbers of how this is going to get under control. You have to start to ask the question of, are bonds an impaired asset class? Are they going to be an environment where they cannot outperform, especially on a real inflation-adjusted basis? And if that is so, again, this is hypothetical, but if that is so, where do you turn to? And so he was making the case for a lot of alternatives. And we've seen a lot of institutional investors go here, especially pensions, endowments, foundations. They've actually been leaders, surprisingly, in the alt space. They have no problem going into alternatives. And so what if everyone always thinks of Bitcoin and other digital assets as this, again, like we talked about before, this risk-on asset, and everyone would always think, well, it's the riskiest thing, so I'm going to take some of my riskiest stuff out of equities and stocks, put it in there. He was saying well, what if people actually take portions out of their bond sleeve, their bond portion, and put it into alternatives, which may include something like Bitcoin as well. So I think that's actually a really interesting thing. And then just one other point on the bond drawdown that I want to bring people's attention to. Everyone looks at bonds as the portfolio stabilizer, but we always have to look at real returns. And everyone likes bonds because they have very shallow drawdowns, right? Because they're the safest, they're the highest in the capital stack, you get paid out first. But on a real basis, because their interest rates are fixed, long duration bonds are at a very high risk of providing you a negative real return. So if inflation comes back, you are going to be underwater on a real basis, right? And again, going back to the 70s and 80s, bonds had a 50% drawdown on a real basis. Nobody talks about this and nobody really knows this, I don't even think. Meaning, if you were invested in these long duration bonds during that time, sure, it looked like you were doing okay. But in terms of the actual money you could take home as for example, retiree to use to eat, you were down 50%. And moreover, you were not just in that drawdown for a year or two, you were in that drawdown for decades. And that's the big thing too, I want to emphasize. Bitcoin, for all intents and purposes, gets a lot of heat it deserves because it has these massive drawdowns of, at least historically, 60, 70, 80%. But historically, they've been very, very short, right? Bonds, sure, it's low, but you could be sitting in that for a very long time. And if you take something like the classic 60-40 portfolio, 40% is a big chunk of your portfolio to be underwater for decades or more.
Yeah. And I think a lot of capital is starting to realize that. We've seen the crowding into the short end of the yield curve to try to escape this. Nobody wants to hold a bond that's over 10 years anymore, because just like you said, the math doesn't math once you get that far out. Yeah. So I think that there's a lot of capital there that's become aware of this and is trying to find another home. I think gold is telling that story. Bitcoin is as well. And so I'm interested to see how that continues to develop and how that landscape shifts, because there's a lot of capital that's, like you said, deep in the red, and it's the advertisement for it is always that, oh, it's stable, but you're right, it's stably losing you money in terms of real performance. I want to turn now a little bit more towards your research reports on Bitcoin itself as an asset. You said in this signals report we've referenced there's a unique mix of headwinds and tailwinds around Bitcoin right now, right? Things that are telling a story that's constructive, and some things that are holding it back. Give us some more detail around this. What is this mix of headwinds and tailwinds, and how is Bitcoin situated right now based on your recent report?
Yeah, the tailwinds are huge on the demand side of at least what we've been seeing. Obviously, corporate Treasury adoption, companies buying Bitcoin. We can't even keep up. We're trying to track this stuff, and there's seemingly a new one announced every day. The number of companies keeps going up. The companies that already hold are buying more and more and more. So obviously we can see that and measure that as a huge source of demand. The other thing we have visibility on is the exchange traded products, or people like to say ETFs, but technically ETPs for us. They are seeing huge amounts of flows. So that's another big source of demand. So then of course the question is, well, where's the selling coming from? Where's the supply coming from? And that's a little harder to see visibly, but on-chain we can see a lot of original or very early adopters and holders of Bitcoin selling. We're seeing very old coins move. Anecdotally, we saw a public release of 80,000 Bitcoin that were moved and then sold from over 10 years ago. I think you mentioned at the top of the show, another 24,000 sold. So clearly the price getting up to this point is making some long-term holders sell. It's finally inducing them to sell for whatever reason. One of the press releases said for estate planning purposes. So eventually at some marginal price, somebody wants to take some and use it for something else in their life. And that's normal. That's good. That's healthy, in my opinion. You're distributing the coins to different investor groups and bases and parties. That's all part of adoption and what you would expect to see. So the question will just be, at what point do those early original holders finally get exhausted? They're finally sold out. And then if this demand keeps continuing to go up, if we're going to have to see price respond to accommodate that, and we'll see. The other big thing on the demand side that I think people are undervaluing they're discounting it too much is the advisor RIA market. And so here again, it's a bit more anecdotal on my side. But there's just so many advisors who are still on the sidelines with their clients. Their clients they can't, or they're prohibited from actively selling any of these products or exposure to them. And that's just going to be, once that's unlocked, it's a slow process, but it's going to be a slow burn, a slow, constant bid for these, because they will be workers and retirees and people who use these advisors and financial planners. If or when they get into things like model portfolios, there'll be a certain amount that they just rebalance into every quarter or every year. And that's going to be a big source of demand. That's still, trillions of dollars out there. So one thing to keep an eye on as well.
Yeah, I think that there's a lot of people, especially who have been in Bitcoin for a long time, think of it as something that is consensus and that everybody has already gotten to, but they don't realize how much and how many different kinds of pools of capital still have not yet gotten access to this market. So yeah, I think the RIAs thing is definitely going to be a game changer when that happens. So I want to ask about this, like, in terms of market structure, like you've situated where we are with Bitcoin right now, a lot of people are saying that we're not going to have another bear market in Bitcoin. And if we do, it'll be a tiny one. David Bailey of Bitcoin Magazine and I went back and forth on X just a little bit about this. I didn't get too heated with him about it, but he's saying that Bitcoin won't see a bear market for years. And, according to the history, the 4-year cycles, a lot of people are saying that, we should be hitting the top sometime around now and going into a bear market. What's your view on this? Do you think that there's something to this extended cycle theory, or is the 4-year cycles just completely over? Like, what are your thoughts on this, and how is this going to play out going forward?
Personally, I do not think cycles in Bitcoin and other digital assets are dead. They just can't be. And number one reason for that is if traditional financial assets, especially things like stocks, still have cycles and regular bear markets, and that's, $100 trillion asset class on a global level, we're certainly going to see bear markets and cycles here, in my opinion. Now, the question of whether we'll see a 4-year cycle, though, is a little more interesting. And I personally think the 4-year cycle is probably dead. You're not going to see it on that clockwork cadence. So remember, people got really excited when they noticed the pattern of the yearly performance of Bitcoin or the candles, and it was green, 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 red, green, 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 red, green, green, green. We're in the third green. You would expect a red, but it's like, why should that be? I think in the past there might have been some good reasons for it. It's very hard to tell because we don't have an experiment we can run. But in the past we had the halving. This also matched liquidity cycles with Fed easings. It also matched things like election cycles. So you had all these things, but you never knew exactly which one was driving it. And personally, I just think, if it were that easy that it was just this same pattern every single time, I don't know. My years in the financial markets tell me like the market's going to do exactly what you least expect it, right? Or there's the old adage, the market's job is to extract the most pain from the greatest amount or number of people possible, right? So I just don't think it's going to be that neat. So I agree that we're going to still have cycles. Probably not going to be 4 years. This one already is longer and is getting elongated. So I think the data is already disproving the 4 years without us even having to argue for it. And I think it's because you have the exchange traded products, you have more institutional buying, you have now like an extra turbo of the corporate treasury trade right now. So all of those things could elongate the cycle. But I just don't think, it always scares me a little bit when you hear people say there's not going to be a bear market, because if it happens in traditional markets, it's going to happen here as well.
Yeah, that's what I keep telling myself. Every time I find myself or thinking or feeling this time is different, I go look in the mirror until I say it to myself out loud till I feel dumb. And then I talk myself down.
The four most dangerous words in finance right there. This time is different.
Yep. Yeah, that's it. Ladies, liquor, and leverage, the other ones. Okay, let's move on here. I think there are a lot of changes that we've seen to the Bitcoin market, though, and in terms of market participants. And I'm glad you brought in digital asset treasury companies because I want to get your couple of thoughts on this. You've highlighted in your analysis recently there are over 35 different publicly traded companies that are holding over 1,000 Bitcoin, which is a substantial stake. And by all intents and purposes, they intend to hold on to that as much as they can. Do you see this digital asset treasury company phenomenon? Do you see this continuing to be a niche in the market, or is this going to broaden out into a reality where like every company is a digital asset treasury company? Like, how do you see this evolving, and what are your thoughts on this phenomenon and market trend in general?
Yeah, we were doing a lot of thinking and studying on the team with this over the past couple of weeks, and hopefully we'll have some more data to show everybody in a little bit. But the first thing we did was, number one, just look at all these companies that have Bitcoin or other digital assets on their balance sheet. And they're not all the same. And I don't mean like same industry and sector and stuff like that, but really you can bucket them into 3 different things. And this is how we went about it. Number one, there's digitally native companies that have these assets on their balance sheet because that's their business, that's their job. So Bitcoin miners, for example, they easily fall into that bucket. Exchanges or other companies that work in the space probably have some. Now they might cross into the other bucket, which is to put extra on their balance sheet. But that's one group. The other group is companies that are purchasing it as a way to diversify their cash balance. And a company like Strategy started out like this. They looked at their $500 million of cash and they said, We can't put this all into bonds or treasuries because it's a melting ice cube. And so to your question, I think there is a world, probably quite a bit in the future yet, where almost every company is going to have some Bitcoin on their balance sheet if, and this is the big if, Bitcoin continues to be adopted as this store of value monetary asset. Because they're going to look at their balance sheet and they say, okay, we don't need this cash for at least 5 years, whatever their risk tolerance is. We don't want to put it into something where we're going to lose purchasing power. So we're going to put it into Bitcoin because we've got a long enough time horizon on it. And then hopefully we can use it for the business later. And they're just diversifying. It's the same as if a company were in, a high inflationary country like a Turkey or an Argentina or whatever. And they said, we're going to get out of some of this local currency and put some in US dollars. To me, it's the same trade or the same setup, right? What's going on now, though, and what's the bigger bucket is what I call like the arbitrage bucket. All of these companies who have realized, hey, we have access to capital markets. We have an investor base out there that cannot get exposure to Bitcoin in the traditional financial markets, whether that's because of their mandates or compliance or regulatory or geographic reasons. Look at like UK or Japan, for example, has these. And they see an arbitrage opportunity. And that is legitimate, in my opinion, where you have, this is true in finance all the time, wherever there's an arbitrage, whenever there's an inefficiency, an entrepreneur will step in and seek to close that inefficiency. And obviously they're doing it not for altruistic reasons, but to profit from it. And so that's what these companies are doing. The big question, though, is how many can the market support and how long does it go on? And I think, that's what we're still seeing play out. I think it could go on a lot longer than what a lot of people think, just because there is so many pools of capital out there that want or could get some exposure yet. But we'll see how it plays out.
Yeah, I think that's exactly where I'm at too. It's like it's clear there's an explosion here. It's clear that there's a lot of momentum to it, but it's not yet clear exactly how this is going to shake out. Who's going to have legs, who's going to stay, how they're going to evolve. So but I thought that perspective in your analysis in your research report was really helpful, and just like bucketing it in that way and like thinking about it a little bit more than just a mania in the market. I want to come now, leaving Bitcoin aside for the moment, and get some thoughts from you on Ethereum. I think that a lot of people have been very surprised by the enormous rally we've seen from Ethereum, from $1,400 in April to just as of this weekend, touching 4,900. I think almost 5,000, right? So it's quite a huge move. Recently, the Fidelity digital assets research team was quoted as saying Ethereum's layer 1 is seeing a surge in transactions, largely due to a 50% increase in the gas limit since March, which is an upgrade they had. Look, everybody I think has spent a lot of time when talking to institutions about digital assets focusing on Bitcoin. What has the conversation been like around Ethereum? How have you framed that? And do you expect this to continue to have traction here? And just like give me some thoughts from you on ETH here.
Yeah, to the framing question, we're pretty adamant that Bitcoin, one of the first reports I wrote was called Bitcoin First. Bitcoin is in its own bucket as best understood as a monetary good because it has these properties that can make it good money. Not saying it necessarily is yet, which is why we say it's an aspiring form of money. So you put that aside, and then you look at Ethereum. And I, for one, am actually very glad that Ethereum has continued to change and evolve because it has really set itself apart from Bitcoin. Before, it was a lot more similar to Bitcoin. It was proof of work. People were talking about ETH as ultrasound money, all this sort of things. And I never, at least personally, held that view. I think Ethereum has a completely different investment thesis and framing for it. So the way we talk about it on the research team is Ethereum's the number one smart contract network. It's number 2 market cap, but it's clearly number 1 in terms of all the metrics of transactions and size and everything else that make up a good smart contract layer 1 network. And to us, it's first and foremost an open source platform to host all of these decentralized applications. And then out of its competitors, to us, it is also the most decentralized and the most globally neutral one. And then it has these properties that enable trustless execution of programmable logic. And that's really its core value prop to me. And that extends Ethereum's utility beyond simple just value transfer. Like we could send ETH back and forth to each other to pay for things, but to me, that's not the real value prop for Ethereum. It's as this smart contract platform. So that's how we position it to our clients. In terms of what you were saying before with like the transactions being up and everything, yeah, we're seeing this in the data, 25% increase in transactions. Whether or not that's sustainable, I think we'll see. Right now, it looks like it is because fees are staying low and you're seeing a lot of demand from its bread and butter DeFi and then also stablecoins. Stablecoins are like the hot thing right now and are, rightfully so. I think they're the killer app use case. I think 50% of value transacted on Ethereum, it comes from stablecoins. And so that's what you see as well. You see people gravitating to Ethereum to do the highest value transactions. Something like Solana maybe has higher volumes, but more of the value is being done on Ethereum. And I think that's because it is positioned as more of a decentralized, censorship-resistant network. So that's what we're seeing. We'll see, though, caveat here is fees can spike. They can go exponential. That, of course, curbs the appetite for the amount of activity you want to do on the network, but we'll continue to watch it closely.
Yeah, I appreciate that. I think that it's always interesting to me to hear how institutional researchers or digital asset teams at larger firms are positioning the value proposition and like differentiating Ethereum from Bitcoin. Because I think the Bitcoin is digital gold narrative is pretty easy to digest, but explaining, well, what is a smart contract platform? What is the value here is always different. So I just wanted to kind of hear your thoughts on that. And that is very helpful. So thank you for that. We're coming up on time, so I'm going to bundle 6 questions into one and let you chew on it however you want. But I'm really interested in this question of like the institutional adoption curve and what changes need to happen in order to sort of like break down that wall and bring that in. Something that I've heard from a lot of people is the regulatory landscape, which this administration has been hard at work changing. Not to go through everything, but like the SEC has Project Crypto exploring tokenization. The CFTC has a crypto sprint that they're doing as well. And the Genius Bill passed Congress. There's also the Clarity Act it's currently being discussed in Congress. From your perspective and your conversations with your clients, how big of a deal is the regulatory environment here? Do you think this is a major barrier, or is it something that they're like not really that keyed into? Like, how big a deal is the regulatory changes that we're seeing happening right now?
It used to be a bigger deal. Now it's not. And I would say the biggest watershed moment was the approval of the exchange traded products. And then even more so now, right, where we're seeing full isolated bills fully devoted to crypto and digital assets, not lumped into another bill or something like that. So it is a factor, but I don't think it was actually, again, from my perspective and maybe more anecdotal, I don't think it was actually a very big factor in terms of allocating, because I think most people were pretty comfortable with the regulatory environment of just holding or investing or buying or selling these things. I think where it's going to help is now the next stage of things like the DeFi stuff, the staking, the infrastructure, all of that. But from an investor's perspective, I really don't think it was that big of a barrier, at least not more recently over the last couple of years.
Well, thank you, Chris. I really appreciate the insight here. I do hope that as that regulatory environment changes, that you'll keep us posted with what the impact that has is. Yeah, I really appreciate you coming on to share your thoughts with us today. Thanks for being on Milk Road Macro. Where can we send people to find more of you and your work online?
Yes, you can go to fidelitydigitalassets.com. And all of our research is there for free. Click on the research tab, read or download whatever you want there. And then for me personally, I'm at Chris J. Kuiper on X as well as LinkedIn.
Awesome. Well, thanks so much for being here. I really enjoyed having you on. I hope you'll come back again soon.
Absolutely. My pleasure. Thank you.
Thank you. And thank you, everyone, for joining us. As a quick reminder, everything that we said today is for entertainment and educational purposes only. This is not financial, legal, tax, or any other kind of advice. Views and opinions expressed here are our own and do not represent professional advice or the opinions or views of any of the programs or businesses we are affiliated with. We are not financial advisors. Please consult a qualified professional if you are making investment decisions, especially when it comes to crypto, as it carries significant risks, including the potential for losses. Thank you all for joining us on Milk Road Macro. This was a great episode, a lot of fun, and I hope you'll join us on the next one. Stay safe, stay bullish, and we'll see you soon on Milk Road Macro. Thanks. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.